There are roughly 26 million adults in the United States. The financial system literally cannot see. Not people with bad credit. People with no credit, no score at all. The CFPB calls them credit invisible. About 1 in every 10 American adults. When they apply for an apartment, a car loan, or their first credit card, the lender pulls their file and finds nothing. And nothing gets treated almost exactly like bad. Here's the strange part. Building a credit score from zero isn't hard, and it isn't slow the way people think. The scoring companies have published the exact rules: what counts, how much it counts, and how fast a score can appear. Most people just never read them. By the end of this video, you'll know exactly how a score gets built from nothing, the 3 tools that do it, the real timeline, and the quiet mistakes that keep beginners stuck at zero for years longer than they need to be. This isn't financial advice. It's the documented mechanics, straight from the CFPB, the Federal Reserve, and FICO itself. Let's get into it. First, let's kill the biggest misunderstanding, because it changes everything. Having no credit is not the same as having bad credit. They feel identical from the outside. Both get you denied, but underneath they're completely different problems. Bad credit means there's a history, and it's negative. No credit means there's no history at all. You're what the industry calls a thin file, or credit invisible. The lender isn't judging you harshly. The lender has nothing to judge. That distinction matters, because the fix is different. You don't need to repair anything. You need to create the record from scratch. And creating a record from zero is, in some ways, easier than digging out of a hole, because you're not fighting against past mistakes. You're starting on a blank page. The catch is the chicken and egg problem everyone hits. You need credit to build credit. Lenders want to see a track record before they'll extend you one, but you can't have a track record until someone extends you credit first. That loop is exactly what stops most people. The good news is, there are 3 specific tools designed to break it, and we'll walk through all 3. Before you build anything, you need to know what's actually on file, and this step is free, which almost nobody takes advantage of. There is exactly one federally authorized website for free credit reports: annualcreditreport.com. Not a lookalike, not an app that wants your card number for a trial, that official site. And here's what changed that most people don't know. During the pandemic, the 3 bureaus temporarily expanded free access from once a year to once a week. And in September 2023, that weekly access was made permanent. So as of 2026, you can pull a full report from Equifax, Experian, and TransUnion every 7 days, free, forever, with no catch. Why does this matter when you're starting from scratch? Because you might not actually be starting from scratch. You could have a thin file you didn't know about, an account a family member added you to years ago, or, and this happens more than people realize, an error, or even a sign of identity theft, sitting on one bureau but not the others. The 3 bureaus don't share data perfectly, so each report can show different information. Checking all 3 is how you find out exactly where you truly stand. To pull them, you'll verify your identity with your name, address, social security number, and date of birth, plus a few security questions about old addresses or loan amounts. Questions designed so only you can answer them. If the online verification fails, you can request the reports by phone or mail instead. One important note: the free report shows your history, accounts, balances, payment records, inquiries, but it does not include your score. That's normal. Many card issuers and free services now show a FICO or Vantage score separately. The report and the score are 2 different documents. So step 0, before you spend $1 building anything, is to pull all 3 reports and confirm what's really there. If they come back empty, you've confirmed you're truly invisible, and now you know your starting line. If something is there, you've just caught it early. Either way, you're no longer guessing. Let's put real numbers on why this matters, because being credit invisible is expensive in ways that aren't obvious. According to the CFPB, About 26 million Americans have no credit record at all, and another large group, tens of millions more, have a file too thin or too old to generate a score. The Bureau's research consistently finds that Black consumers, Hispanic consumers, and people in low-income neighborhoods are the most likely to be in this group. So this isn't a niche problem. It's a structural barrier standing between millions of people and basic financial access. And the cost of staying invisible compounds. A landlord runs a credit check and sees nothing, so they ask for a bigger deposit, or reject the application. A car loan gets approved, but at a subprime interest rate, because the lender is pricing in the unknown. In 2026, the average interest rate on new credit card offers is running around 23.8%, per LendingTree's tracking of the market. But people without established credit often can't even access cards at that rate, let alone a better one. Every year you stay invisible is a year of paying more for everything you borrow, or being locked out entirely. Here's the opportunity hiding inside that problem. A score can start existing in as little as 6 months. Half a year of the right, small, deliberate actions can move you from invisible to visible. Let's break down exactly how the score works first, because you can't build something well if you don't know what you're building. A FICO score runs from 300 to 850, and FICO, the company used by 90% of top lenders, publishes exactly what goes into it. 5 categories, 5 weights. Memorize these, because every single move you'll make maps to one of them. Payment history, 35%. The single biggest factor. Do you pay on time? This is more than a third of your entire score, and it's the one you have the most direct control over. Amounts owed, 30%. This is mostly what's called credit utilization. How much of your available credit you're actually using. Nearly another third of your score, and, importantly, one you can change fast. Length of credit history, 15%. How long your accounts have been open, and their average age. This is the one factor time controls. Not you, which is exactly why starting early matters so much. New credit, 10%. How many new accounts and hard inquiries you've added recently. Applying for a lot of credit at once signals risk. Credit mix, 10%. Whether you handle different types of credit, revolving cards and installment loans. Notice something. Payment history and amounts owed together are 65% of your score, nearly 2/3. For someone building from scratch, that's the entire game early on. Pay on time, keep balances low, and you're directly controlling the 2 levers that matter most. Everything else is secondary at the start. One more essential fact, straight from FICO, to generate a score at all, you need at least one account that's been open for 6 months or more, and at least one account reporting to the bureaus within the last 6 months. That 6-month floor is why nobody builds a FICO score overnight, and why the number one thing you can do is simply start the clock as soon as possible. So how do you actually open that first account when no one wants to give a no-history person credit? 3 tools. Each one is built specifically to break the chicken and egg loop. Tool 1, the secured credit card. A secured card works like a normal credit card with one difference. You put down a refundable security deposit up front, and that deposit usually becomes your credit limit. Put down $300, you get a card with a $300 limit. The deposit is collateral. It protects the lender, which is why they'll approve someone with no history. But here's the key. The card then reports to the bureaus exactly like a regular card. Every on-time payment builds your payment history, that 35% factor, month after month. The critical detail most people miss. Only pick a secured card that reports to all 3 bureaus, Experian, TransUnion, and Equifax. If it doesn't report, it does nothing for your score, no matter how perfectly you use it. And look for one that graduates, meaning after 6 to 12 months of on-time payments, it converts to a normal unsecured card and returns your deposit, while keeping the account open so you don't lose that hard-won history. Tool 2, the Credit Builder Loan. This one is a loan in reverse, and it's clever. Instead of getting money and paying it back, you make fixed monthly payments first, and the lender holds that money in a locked savings account you can't touch yet. At the end of the term, usually 6 to 24 months, you get the money back, minus a bit of interest or fees. You're essentially paying to build a payment record, and you walk away with a small pot of forced savings on top of it. Every on-time payment reports to the bureaus, and here's the part that makes it uniquely useful for someone building from scratch. Because it's an installment loan rather than a card, it helps your credit mix. That 10% factor a card alone can't touch. It also builds payment history, the 35% factor, in parallel with your secured card. Two different account types, both reporting positive history at the same time, is exactly the kind of profile the scoring models are built to reward. These loans are commonly offered by credit unions and community banks, and increasingly by online lenders. But the same rule applies as with everything else here. Before you sign, confirm it reports to all three bureaus, because a credit builder loan that doesn't report is just a savings account with extra steps. Tool 3. Becoming an authorized user. If someone you trust, a parent, a spouse, has an old credit card with a strong history and low balances, they can add you as an authorized user. Their account's history can then appear on your credit report. This is the one tool that can sometimes produce a score faster than the standard 6 months, because you're inheriting an existing, aged, positive history rather than starting a brand new one. But there's a hard warning attached. It cuts both ways. If the primary cardholder runs up a high balance or misses a payment, that damage can land on your report too. Only do this with someone whose financial discipline you genuinely trust, and confirm the card issuer actually reports authorized user activity to the bureaus. Not all of them do. Let's walk through a realistic, illustrative scenario. This is a hypothetical to show the mechanics, not a promise of any specific result. Meet Alex, 22, first job, zero credit history, completely invisible. Here's a disciplined path. Month 1. Alex opens a secured card with a $500 deposit, chosen specifically because it reports to all three bureaus and graduates after a year. Alex also opens a small 12-month credit builder loan with a $25 monthly payment. Months 1 through 6. Alex uses the secured card for one small recurring expense only, a $15 streaming subscription, and pays the statement balance in full, on time, every month. The credit builder loan payment goes out automatically. 2 accounts, both reporting, both perfect. Around month 6, because Alex now has accounts open and reporting for 6 months, a FICO score generates for the first time. Alex is no longer invisible. Here's the discipline that makes it work. Alex keeps the card's reported balance tiny. Utilization, that 30% factor, is calculated on the balance the card reports, which is usually the statement balance. By keeping that $15 charge against a $500 limit, Alex's utilization is about 3%, well under the 10% that's considered ideal. Low utilization plus a spotless payment record is directly optimizing the 2 factors worth 65% of the score. Compare that to Alex's friend Jordan, who gets the same secured card but treats it like free money, runs it up near the $500 limit each month, and occasionally pays late. Jordan is also building history, but building it badly. High utilization drags the 30% factor, and every late payment damages the 35% factor, which is the hardest one to recover. Same tool, opposite outcome. The tool doesn't build your credit, how you use it does. Getting your first score isn't the finish line, it's the starting line. Here's what a smart build looks like after month 6, because this is where most guides go quiet and where a lot of people stall out. Around month 6, your score appears for the first time. Don't panic if it's modest. A brand new score built on 1 or 2 young accounts is often in the fair range, not the good range, that's expected. Length of credit history is 15% of your score, and you simply haven't had time to earn it yet. At this stage, the only jobs are keep paying on time, keep utilization low, and don't go apply for 5 new things just because you finally have a number. Let it age. Around month 12, 2 things typically become available. First, many secured cards will graduate. After roughly 6 to 12 months of on-time payments, the issuer converts your secured card to a regular unsecured one and returns your deposit, while keeping the same account open. That's ideal because you get your money back without losing your oldest account's history. Second, some issuers automatically review your account for a credit limit increase. Capital One, for example, states that after your first 5 monthly payments on time, it automatically reviews the account for a potential credit line increase. Why does a higher limit help? Because utilization is your balance divided by your limit. So a bigger limit, with the same spending, means lower utilization, which helps that 30% factor. A limit increase you didn't ask for and don't spend against is a quiet score boost. Around month 12 to 24, this is when it's reasonable to thoughtfully add a second account, maybe a basic unsecured card, or if you only had a card so far, a small installment loan to improve your credit mix. The key word is thoughtfully. One new account, when there's a reason, spaced out, not a spree. Each addition slightly lowers your average account age and adds a hard inquiry, so you want the benefit of the new trade line to outweigh that small, temporary cost. By the 2-year mark, someone who started from zero and stayed disciplined has aged accounts, a clean payment record, low utilization, and often a genuinely good score. Notice the shape of this. The first 6 months are about existing. The next 18 are about aging and widening, letting time work on the 15% length factor while you occasionally, carefully, add depth. There's no shortcut for the aging part. That's exactly why the single most valuable move, again, is to start as early as you possibly can. Here's where beginners quietly sabotage themselves. These mistakes don't feel like mistakes in the moment, which is exactly why they're dangerous. Mistake 1. Applying for everything at once. When you're eager to build, it's tempting to apply for 3 cards in a week. But every application triggers a hard inquiry, which dings the new credit factor, and a pile of new accounts lowers your average account age. Space applications out. Apply only when you actually need to. Mistake 2. Carrying a balance to build credit. This is the most expensive myth in this entire topic. You do not need to carry a balance and pay interest to build credit. That's false. Your card builds your score by reporting your activity, whether or not you carry a balance. Paying in full every month builds credit and costs you 0 interest. Carrying a balance just hands the issuer money for nothing. With average APRs on cards accruing interest running above 22% in 2026 per Federal Reserve data, that myth is costing believers real money every month. Mistake 3. Closing your first card once you get a real one. Your oldest account anchors your length of credit history factor. Close it, and you can shorten your average account age and shrink your total available credit, which raises your utilization overnight. That first secured card, once it graduates, is often worth keeping open for years, precisely because it's your oldest. Mistake 4. Using a card or loan that doesn't report. Some products, certain fintech cards, debit-style products, credit builder gimmicks, don't report to all 3 bureaus. If it doesn't report, it doesn't build. Confirm this before you sign up, not after 6 wasted months. Mistake 5. High utilization even when you pay in full. This one's subtle. If you charge a lot and pay it off after the statement closes, the card may still report that high balance to the bureaus first, spiking your utilization even though you never paid a cent of interest. The fix: pay the balance down before the statement closing date, so the number that gets reported is low. None of this is advice about which specific card or lender to choose. It's simply what the data and the published scoring rules show about where beginners lose ground. Let's put the numbers that matter side by side, all current as of 2026. The score scale, FICO, 300 to 850. Broadly, 670 and above is considered good. 800 plus is exceptional. The 5 factors: payment history 35%, amounts owed 30%, length of history 15%, new credit 10%, credit mix 10%, published by FICO, minimum to generate a score, at least one account open 6+ months and reporting, per FICO. This is the 6-month floor. Utilization targets. Under 30% is the common baseline. Under 10% is considered ideal. The cost of getting this wrong. Average APR on cards assessed interest was around 22% in 2026. Federal Reserve, G.19, and new card offers averaged roughly 23.8%. Lending tree. Carrying balances at those rates is the expensive path. The scale of the problem. About 26 million Americans are credit invisible, per the CFPB, roughly 1 in 10 adults. Notice the pattern in these numbers. The 2 things fully in your control from day one, paying on time and keeping utilization low, are also the 2 most heavily weighted factors, at 65% combined. The system is built so that the behaviors that help you most are also the ones you can start doing immediately, with a single small account. So if you're starting from zero, here's what the data points toward. Framed as general education, not a personalized recommendation. First, start now, because the single biggest constraint is time, and the 6-month clock only starts once an account is open and reporting. Every month you wait is a month added to the end, not one you can skip later. The length of history factor rewards early starters permanently. An account opened today is always older than one opened next year. Second, open at least one reporting account, most commonly a secured card, a credit builder loan, or authorized user status, and confirm it reports to all 3 bureaus before you commit. Third, automate on-time payments. Since payment history is 35% of the score, and a single late payment can stay on your report for up to 7 years, set autopay so a missed due date is never what sets you back. This is the highest leverage habit in the entire process. Fourth, keep utilization low, ideally under 10% of your limit on what actually reports. Charge small, pay before the statement closes, and let the low reported balance do the work. Fifth, be patient and consistent. A score appears around 6 months, but reaching good credit typically takes a year or more of steady habits. This is a slow compounding process, and the people who win are simply the ones who don't quit or self-sabotage along the way. And an honest note, if you're building credit while also dealing with existing debt, a nonprofit credit counselor, for example through the National Foundation for Credit Counseling, can help you build a plan for free or low cost. There's no shame in getting guidance built around your actual situation. Let's go back to those 26 million invisible people. The thing standing between them and a score isn't money, and it isn't some secret. It's information and a start. The scoring rules are published. The tools exist and are designed for exactly this. The only ingredient that can't be rushed is time, which is why the most valuable thing you can do is begin. Building credit from scratch comes down to a sentence. Open one account that reports, pay it perfectly, keep the balance tiny, and don't close it. Do that, and in about 6 months you go from invisible to visible. And from there, good credit is just consistency and patience doing their work. There's no trick, and no reason to pay anyone to do this for you. The bureaus give you your reports for free, the scoring rules are published, and the tools cost a refundable deposit at most. Everything you need to go from zero to a real score is already available to you, starting today. Every number in this video came from a primary source: the Consumer Financial Protection Bureau, the Federal Reserve, and FICO's own published scoring education. Not opinions, not guesses. This was educational, not personalized financial advice. Your income, your debts, and your goals shape what's actually right for you. and a licensed professional or a nonprofit credit counselor can help you build a plan around your real situation. If this made the credit system finally make sense, subscribe, because understanding how money actually works shouldn't require decoding a system that was published in plain sight the whole time.